Okay, I think more or less everyone has come in already. So welcome again to those who have just joined to our XM webinar. Good morning to all of you. Um, so today I'll be covering on major continuation patterns. I know on Tuesday my colleague covered the same topic, so it is actually a repeat of the exact same topic, right? So sorry about the repeat. There might be some confusions, right, at the on the XM side, but my instruction was to cover major continuation patterns again. So for those who have attended the Tuesday lecture, you can either be experts at this topic, or um, uh, uh, you can tune out actually. For those who never attend the Tuesday lecture, then you'll be good because I'm actually covering a new topic for you, and you all didn't actually miss on Tuesday because I'll be covering almost exactly mostly about the same patterns, right? So before I move into major continuation patterns, everyone know it's the end of March, right? And March has been a crazy trading month, right? Why is because of the bond yields, the worries, the vaccines, the stimulus, right? So gathering from everything now, it looks to be more positive, right? Vaccines are rolling out. Moderna and Pfizer are showing good results, right? um, Shots of Johnson are also being accepted all around the world, right? As for the US side, more and more money is pumped into the economy, right? With Biden just releasing the 2.3 or 2.36 trillion stimulus, right? Yes, just yesterday on infrastructure, and before that he actually gave the 1.9 trillion stimulus, right? So all's looking good with a lot of stimulus in the economy. This is all backed up together with how Jerome Powell said he will let inflation run wild because he want to see recovery in the economy as well, right? From the virus. So everything actually is looking up. Just that investors have the worry of the bubble, right? And also of the economy overheating, which is why sometimes you can see sharp drops, right? And March was actually a one such drop, right? With a steep adjustment in most of the stocks and forex pairs, right? If you notice in March, most of the stocks diagrams looks quite similar, right? Is because most of the stocks are all undergoing adjustment, and a lot of the tech stocks, for example, like Tesla or Pinduoduo or JD, right? They all look the same. Is because they are highly correlated to market, right? Everyone is talking about it now, right? Everyone is talking about e-commerce. Everyone is talking about electrical vehicles, right? So these stocks are highly correlated to the market, and this is why they have similar graphs. So what's the point of me bringing out this is because this is the exact reason why we need to get better at looking at chart patterns, because chart patterns is getting more and more prevalent in our chart nowadays. So looking at chart patterns and determining the trend for the long-term direction is very important as well. Of course, you can say you are a scalper, you are in within 1 and 2 hours. You can say that the diagram doesn't really matter. However, you are wrong, right? Because you can also see this kind of patterns appearing on like 1 minute chart, 5 minute charts, 15-minute charts as well, right? And the patterns in the smaller time frames do affect the larger time frames, like candles as well, right? For example, 1 second candles can affect a 1 minute candle, right? And 61-minute candle can affect the 1 hour, the hourly candle, right? So looking at chart patterns to determine the trend, right? To determine the trend and to trade according to the trend, or if you are a counter trader, trade against the trend, right? Trading against the trend or trading with the trend is very important to our trading strategies, right? Which is why I'm covering this today to show you some of the major continuation patterns. Okay, so today's topic is actually very simple, right? Because all I'm going to do is just going to introduce you all to some of the patterns and then show you some of the charts at how the pattern have worked out, right? There's not much to understand, but more to take in, so that or like take notes from, so that next time when you see the pattern yourself, you know what is awaiting for you, or you know when to enter the trade or exit the trade, depending on your own knowledge of the pattern, right? So there's actually just two parts to it. The first part I will just be covering the slides, right? And then the second part I'll be showing you all some of the real life patterns on the charts. Okay. Some I have put on Google Docs, right? So it is not on TradingView. So sorry about that. Okay, without further ado, let's start on the slides first. Okay. So, like I said, we will learn about continuation patterns. So here are some of the major categories of continuation patterns. You have your triangles, you got your wedges, you got your pennants, you got your flags and rectangles, right? So all these patterns, what does it mean? I'll slowly cover out with you. Okay, so for continuation pattern, if you all have attended my previous lectures, actually it's very simple, because the prerequisite for any continuation pattern is the existence of a prior trend, right? If there's no trend before the pattern, you cannot the trend pattern is not valid, right? So for example, if I have a trend, right, uptrend, right? The uptrend is characterized by the higher highs as well as the higher lows, correct? So here is the higher highs, here is the higher lows. So with an uptrend, and then for example, you see a wedge pattern, right? A falling wedge pattern, and you know that there's a continuation of the uptrend, right? However, if the previous one was oscillating, right? If the previous one was oscillating, right? Within these two bands, right? And then you see a falling wedge here. Not saying that it might not increase, right? It's just that this pattern is not valid, right? Because the prerequisite for any pattern is that you have to see a previous trend, right? So in this case of oscillation phase, you don't see a clear trend, right, before. So you cannot say that it will be a high it is a high chance that you will break out, right, of the pattern when the pattern is not even valid, right? So continuation pattern indicate a temporary pause in the trend, right, where prices consolidate before resuming in the same direction. This is actually quite understandable, because during the pattern, you don't see much movement, right? You don't see a clear trending pattern, or you don't see a clear downtrend or uptrend, right? You only see like oscillations, right, while it is forming the pattern. For example, like I said just now, the falling wedge pattern, right, is not going to have much obvious movement. It's going to be a slightly slanting downwards, means a slight downtrend, but however, most of the candles are still in an oscillation movement. Okay, so continuation pattern is actually a pause in the trend. Okay, the next move in the same direction, the next move after it breaks out of the chart pattern will be in the same direction of the trend, right? And the trend will be the preceding trend. Like I said, the prerequisite is to have a trend. So after the breakout of the pattern, it will be in the preceding trend, which is what gives it its name, right? Continuation pattern, the continuation of the preceding trend. Okay, and last but not least, trading volume is actually very, very important in confirming these price patterns. If you all see in my previous lectures before, you all will hear me say that you cannot just based on one factor to determine the trend or determine the direction of the prices, right? You have to depend on many factors. And as for continuation patterns, as for reversal patterns, the most important, actually I wouldn't say most important, an important factor, right, will be the volume, right? So now we got our requisites, right? There's three requisites. The first requisite is the existence of a prior trend. The second prerequisite is that the in the pattern itself, there's not much movement in the candles, right? You can see some oscillation, but you can see the pattern clearly. And the last one is you must look at the volume. If the volume is low or high, it does say something about the pattern. Sometimes, for example, if you are looking at a cup and handle, for example, a cup and handle is a trend continuation pattern as well. But I will not be covering in this because it's chart pattern, right? This is chart pattern. That one is just chart shapes, right? So for example, cup and handle, it signals a uptrend. However, the increase in prices have to look for high volume. So when you see a cup handle, let me just draw it out for you. So for example, you see a cup handle, and for example, it's pulling back already. So it's making the handle, right? So when we break out, the reason, the time that you will break out is when there is a sudden influx of volume. And if you are very good at looking at chart patterns, and you are very proficient at looking at chart patterns, you know that usually volume will be almost 3 times as much as usual volume. So this is the volume bar. Let's say this is volume, and you suddenly see one day it spike up to almost 3 times the usual height of everything, and you know that there's usually a breakout in the trend, and in the chart pattern, and there will be a increase in prices, right? So volume is actually a very important indicator as well to look for when you are looking at trend continuation patterns. So like I said earlier, these are the most common trend continuation pattern. You have your triangles, you got your wedges, you got your flats and pennants, and you got your rectangles, right? So I will move into detail to cover each of it later. So let's take a look at triangles first. So we have 3 types of triangles. The first type is ascending, the second type is symmetrical, and the last type is descending. So this is actually, like I said, there's nothing much to understand, right? It's just for you to take in, because it's just looking at the pattern, right? So like you can see ascending triangle, basically the top line is straight, while the bottom line is ascending, right? It's currently you can see there's a downtrend, there's an uptrend here, right? There's a lower high, and is making higher lows, right? Sorry, is making higher lows, right? You can see it's making higher lows. However, the top of the triangle is straight. So you can see that it is straight. So you can see that actually it's in oscillation phase, right? It's in oscillation phase actually. So this is actually the ascending triangle. Then you have your symmetrical triangle. You got a lower high as well as higher low, right? And when you see this, the triangle is converging, right? There's a converging triangle. This is just a ascending triangle with a straight top and then a ascending base. While this one is a converging triangle. It's almost like a isosceles triangle, right? And then you have your prices into a squeeze, right? So this is a symmetrical triangle. And lastly, we have your descending triangle. For a descending triangle, you have your lower highs. You got your lower highs as well as your same lows, right? Just like the ascending pattern is just opposite, right? So for the descending trend, you can see that on top you have a descending trend, while the lows is all connected by one straight line, right? So it's not considered a squeeze, right? This is the squeeze, while this is just a descending triangle. So what does this 3 triangles show, right? Let me just erase all my drawings. Okay, so let me just move on to what does this 3 triangle show. Okay, so firstly, let us talk about bullish triangles. Okay, so for bullish triangles, the pattern contain at least 2 lower highs and 2 lower lows, right? So you can see here. Let me just circle it out for you. You can see 2 lower highs, and you can see 2 lower lows, right? So when these points are connected to the apex, right? So this is the apex, in case you all didn't know what is the apex. So the triangle is formed. So let's just say the trend is going this way, right? And you can draw the triangle out, right? Sorry, my drawing is not very good. And then and then the triangle can be lengthened all the way to the apex, right? So later I'll show you some graph on TradingView, no worries for that. But now I'm just using the slides to explain, right? So when it's using this pattern and you are connecting the uptrend line with the downtrend line, sorry, the trend line from above as well as the trend line from below, not uptrend line or downtrend line, trend line from above and trend line from below, you can connect it into a triangle, and then you have the apex here. The apex is basically the tip of the triangle, right? So volume should decrease as the price moves within the triangle. So here in uptrend, right, prices volume should be increasing day by day, right? As volume increases, which is why it leads to the signaling of an uptrend, right? However, when price enters the triangle, prices will become small, right? Prices will decrease, okay? And then the breakout will happen between 2/3 to 3/4 of the width of the triangle. So what does that mean? I already showed you all. So this is the entire triangle, right? This is the entire triangle. So 2/3 is about here, right? As drawn by this line here, 2/3, and then at 3/4, right? So it is expected to happen within here. So the breakout is actually expected to happen within here, either breakout to upside or breakout to the downside. Once again, breakout to upside or downside is based on the preceding trend. So if the preceding trend is uptrend and you know that this is a bullish triangle, it will probably break out to the upside. So it will break out the upside, come back to retest the triangle before it pushes up even further. So this is actually a bullish symmetrical triangle, right? So at the breakout, which is this point, let's just say at within 2/3 or 3/4, at this point it broke out, right? The volume should increase, right? So as it enters the triangle, it decreases. Once it break out, there should be an increase in volume, and then it confirms the breakout, right? It confirms the breakout. So this is actually basically it, right? This is basically the bullish symmetrical triangle. Okay, let me just erase my drawing again. And we can move on to our next slide. So just now was the bullish triangle. Now we have the bearish triangle, right? So the bearish triangle is actually directly opposite of the bullish triangle. So basically you do the same thing. You connect the points, right? You connect the points, and then you can form the apex, right? After you form the apex and the triangle, you do 2/3 of the triangle and 3/4 of the triangle, right? So this is the entire triangle. Here is about 2/3, right? So if I were to split, here you can see that this is 1/3, this is 2/3, this is 1/3, right? So 2/3 means 1 and 2, 2/3, right? 3/4, if I were to split into four times, which is about here, like 1, 2, 3, 4, right? Roughly. I wouldn't split exactly, right? You nothing is ever exact in charting, right? So if I were to split into 4, you can see at 3/4 and 2/3. Within 2/3 and 3/4, there will be a breakout. And when there's a breakout, as I said before, volume when entering the triangle will decrease. And when the breakout is happening, the volume will increase, right? So back to the point about 2/3 and 3/3. It's not exactly, I would say, 2/3 to 3/4, right? You cannot just based on the spatial arrangement of the chart and then you determine, oh, I think it's a breakout because it's happening between the 2/3 of the triangle and the 3/4 of the triangle, right? So how do you define 3/4 of a triangle or 2/3 of the triangle? You can't really define it on the chart, right? Unless you there's basically no way to determine it on the chart whether it's 2/3 or 3/4, right? So once again, what I want to bring you all to is looking at the volume, right? When the volume is high, there's a higher chance of a breakout. Once again, I want to emphasize on the higher chance, right? Because it might just be a fake out as well, right? It might just be a fake out. So when you are looking at patterns, it's important to look at the pattern, look at the preceding trend as well as the volume, which brings us back to the first slide that I went through. The prerequisites of a trend continuation pattern. When looking at a trend continuation pattern, you must look out for all these three things before you can consider buying entry or selling entry, right? So now we have the measuring techniques. Let me just finish the slide so it's easier for me to explain. Okay, so here we have the bullish measuring technique, right? About where to take profit and where to put your stop loss, right? So this is what in the slide. I do not completely agree with this because usually what I do is I will use Fibonacci levels, right, to determine my take profit and stop loss, right? Instead of using a special like way to measure, right? However, it is a guide. It is a guide to how you can determine the time to reach the take profit as well as whether your take profit is valid as well, right? So let me just read the slide first. Maybe later I can show you how to use Fibonacci to determine your entry, right? So the first thing they do is measure the height of the base of the triangle and extend the distance from the breakout point. So basically what they are saying is you measure this length, right? You measure this length and then you copy paste this length to this length from the apex, right? So this is roughly how much it will increase, right? So they are saying that this length will be equal to this length, right? So this is the first technique, right? This is the first technique. So the second technique is to draw a parallel line to the lower triangle. Where the parallel line meets the apex, we know where the price, will be and when the price is expected to reach the level at the date where the apex is, right? So sorry, this is the second method. What I'm saying is this is the second method. You make it parallel, and then from the apex, right? From the apex extend out, right? And you can realize that both is about the same height, right? When it's about the same height, then you know this is your take profit level. Okay. So once again, I want to repeat myself that actually this measuring technique I wouldn't really recommend, right? Because there's it won't be so accurate, right? When you just measure like the length, right? Just the length of the triangle, right? And also, how do you measure the length of a triangle, right? Actually, is by using fibs as well, right? So, for example, what I will do in this case is first, after I see a breakout, right? After I see a breakout, I will set a buy entry at the trend line, right? Because I know that if it breaks out, there's a high probability that prices will come back to retest the trend line and then push up, right? So when prices are at the trend line, I enter the position, right? And then my stop loss, my take profit will be, for example, 127.2%, right, of my Fibonacci level. So I will draw a retracement from here to here, right? And I will determine the take profit to be 127.2%, right? This is one of the method that I can use to take profit, right? And another thing I can probably do is to take a Fibonacci extension, right? I want to find a zone. Whereby the prices are confluencing to whereby the Fibonacci levels are confluencing together, right? So maybe I will take a extension from low to high to low, right? When I take an extension from low to high to low, and then I'm trying to find a resistance level. So maybe for Fibonacci extension, I'll maybe take the say 100% level, right? 100% extension level. And if you see these two level match up, then yeah, sure, it is probably a strong level. And the last thing I will do is to find graphical levels as well. If I see there's many movement in the past, right? In the past, and then I will probably set my level to be below this level because I know that it is a strong resistance level, right? It's a strong resistance / support level. So at a strong support level, I know that prices are pulling back and it's a pullback resistance, right? So it is more likely that I'll set it at a graphical level as well. So using these three, I will set my take profit or stop loss targets instead of using like measuring the height and of the triangle, which is more inaccurate in my opinion, right? However, if you think that measuring the triangle is accurate way, I'm not stopping you, right? I'm not saying that it's wrong or it's bad, right? I'm just saying for my style, I would like to prefer to use Fibonacci to uh, find my take profit level or stop loss level, right? As for my stop loss, I will, for example, take a negative 27, right, of this retracement, or maybe I will take a extension as well from here to here to here, right? From high to low to high, and then I can find a extension, maybe 127.2% extension, right? And maybe a negative 27.2% of retracement, and this will be my stop loss, right? So this is basically how I will approach a pattern and how I will enter when I go in a pattern. Okay. This is the same, so I wouldn't be covering too much about it. Just now was bullish measuring, now it's just flip it over. Basically it is breakout to the bearish side, right? When I say bullish side, you take from the apex straight up parallel to this line, measure the distance, and at the time of this will be the time of this, so you can roughly estimate when your take profit and where your take profit is, right? So I've already mentioned just now that is not the best method, and is something that I wouldn't use because I think it's not very accurate, right? And I have already shown you how I would do it via Fibonacci retracements and extensions, right? So I wouldn't be covering a lot on these slides. Okay, now let's move on from triangles, right? We are bored of looking triangles. Let's move on. Okay, so now we look at bullish wedges. Okay, so what is a wedge? A wedge is actually a pattern identified by two converging trend lines that are wide at the base and contract as they come together at apex. It is an intermediate pattern that takes more than 25 candles to form, but not more than 75 candles. A bullish wedge has a noticeable slant towards downside against the prevailing trend, and a falling wedge is considered bullish, while a rising wedge is considered bearish, right? So later I will show you examples of that as well, right? And like triangles, the same breakout periods and measuring techniques apply. Okay, so let's move on to bullish wedge, right? Okay, so for bullish wedge, you look as if like it is looking like a triangle, right? However, the way to identify is basically it is not really a triangle, right? Remember, there's three triangle patterns, right? There's three triangle patterns. One is a descending triangle, right? One is a descending triangle. One is a symmetrical triangle. One is a symmetrical triangle, and one is a ascending triangle, right? This is ascending triangle. So this is descending, symmetrical, and ascending, right? However, you look at the apex, right? Both is actually slanting, just that one is slanting more than the other. So for the apex, if it's a rising wedge, if it's a wedge pattern, what apex? If it's a wedge pattern and it's a bullish wedge, means a falling wedge, right? Bullish is always falling. So for a bullish wedge pattern, there will be one thing slanting down, right? And then there will be a higher degree slant on the upside, right? And this will be a wedge pattern. So be careful, Do not look at the wedge pattern like a triangle pattern. Even though they do almost the same thing, right? You see prices start to consolidate within the wedge, right? And then at the end of the wedge, it will break out of the wedge, and then come back to retest at the top of the trend line of the wedge before it pushes up, right? So this is actually a rising wedge. However, for a falling wedge, right? For a rising wedge, so this will be a rising wedge. Same thing, one is slanting up with higher degree than the other. So one is slanting up, one is a higher degree. And then before that is a falling pattern, right? Before that is is a downtrend, right? And then at the rising wedge, it will consolidate a bit. Prices are moving up slightly before it breaks out of the trend line and retest before it pushes down further to continue the downtrend, right? To continue our downtrend here. Okay, so this is exactly the same way of calculating as a triangle. And like I said, once again, I wouldn't recommend using this method to calculate because it's not exactly accurate, right? And also, one more thing I want to bring your eyes to is 25 and 75 candles, right? So I don't really want you to go to the wedge pattern after you see and start counting the candles, right? So the general thing that I'm pretty sure XM want to put it out there is saying that it's an intermediate pattern, it's not a long forming pattern, right? So they are saying that it shouldn't form for too many days, right? Or it shouldn't, but it's not asking you to actually count the candles between 25 to 75 candles, right? It's like, oh, only got 24 candles. It's not a falling wedge. It doesn't work like that, right? It doesn't work like that. So please don't go and count the candles, right? It's just a aggregation. And the main point XM want to bring to you, I feel, is that they are trying to tell you that it is intermediate pattern and it's not a long-term pattern or a short-term pattern. Okay. If not, if everyone has no question about the wedge, then I'll move on. So just like the bullish wedge, remember the bearish wedge is always rising. So for wedge patterns, it's actually opposite, right? So this is why it is more it is dangerous if you mistaken it with a triangle pattern, because if it is a rising wedge, right? It is a rising wedge, and you think it's a ascending triangle, and then price breaks out on the upside, it might just be a fake out for the bearish wedge, because you have to know the bearish wedge will break out from the downside. So if there is a small breakout at the upside, you might mistaken it for a triangle, and if you go long on it, then you will basically suffer losses, right? So please be discerning of these two, even though I know that it is quite confusing, but basically I have already told you all and taught you all how to look at these patterns, right? So a wedge is basically one slanting at one angle and one slanting at a higher angle. While triangles, remember there's only three, right? There's only three. Ascending with the top being the same and a bottom with the top being, sorry, let me just draw it again. So for triangle, there are three patterns, right? With the top being the same, below is ascending, right? Or there is symmetrical triangles. Both are converging, right? Remember, this is not the same as wedge, right? Wedge is both towards the same angle, just both towards the same direction, just that it is slanting at a different angle, right? Both is slanting up, but one is slanting at a different angle. And the last one for triangle is a descending triangle, where below is the same while on top is decreasing, right? So please do not complicate yourself triangles with wedges pattern, because it is quite different, right? It's quite different. Although, like I said again, all three, both is signaling a bearish or bullish continuation pattern, right? So for bearish wedges, unlike bullish wedges is downward sloping, while bearish wedges is upward sloping. So this is the thing that you need to remember, right? And for bearish wedges, if it's upward sloping, you'll be expecting a breakout in the downside, and you will expect the trend before to be in a downtrend. So actually a very simple way to look at chart continuation patterns is actually to look at the previous trend, right? If you are looking at an uptrend, right, and you see suddenly a downward sloping wedge, you will know that it's a bullish wedge, right? Because you are expecting prices to continue having the uptrend, right? So like I said, everything brings us back to our first slide, right? Because when you look at the trend, it is a prerequisite to have a trend. And this allows you to look at the prerequisite as well, because when you're looking at whether it's an uptrend or downtrend before you are expecting the bearish or bullish wedge, you will actually be confirming whether there is a trend or not before you can look at the chart patterns, right? So the trick to it is to look at the general trend first, and the trick to looking at the general trend is to look at a higher time frame chart. So like the day chart or the week chart, right? Look at the general trend. It is a uptrend, for example, and then you go down to the daily, it's still uptrend, right? And then maybe on the hourly chart, then you can find all your chart patterns which affects the daily uptrend. So because like you said, like I always say, trend is your friend, right? A trend will a trend will highly likely be able to continue over a period of time, right? So you wouldn't expect a uptrend to break suddenly, right? So for example, if you see a uptrend of weekly, right, it's not going to break so easily, and it is always continued by all these continuation patterns. So after you look at the general trend, you zoom in to your smaller time frames to look for these continuation patterns to find your entry. Or else, if it's always on the uptrend, there's you will think, oh, where's my pullback? Where's my pullback? Where can I enter? Right? You can actually enter on these continuation patterns. So we have moved on from now we have moved on, right, from triangles and wedges, right? Now I'm showing you flags and pennants. Okay, so once again, today, since the topic is on chart continuation, once again it is almost the same thing again, which is chart continuation, right? So the flag and pennant represent a brief pauses in dynamic market move, both preceded by an almost straight line move called a flagpole, which happens on heavy volume. Prices then pause for a few candles on very light volume. The move continues on a burst of volume. Both patterns occur at about the midpoint of the market move, which means the market is expected to move up at least the distance of the flagpole. Okay, so it might seem to have a lot of words. However, let me just simplify it for you all. Okay, flag first. Let's look at the flag. So the flag is actually characterized by two straight lines, right? Two straight lines. So once again, don't mix it up with rectangles, right? Because this might seem like a rectangle at first, but however, you can see the straight up trend here, right? Combined with volume, right? So once again, to identify chart patterns, you have to look at the volume, because the volume is actually very integral in looking at the trend, right? In looking at the chart pattern, right? So if the volume doesn't agree that this is the pattern that's forming, you cannot forcefully fit in, right? Don't ever get married to the chart pattern, right? For example, you see like head and shoulders, and you keep thinking, oh, it must be a head and shoulders, it must be a head and shoulders, even if let's just say head and shoulders, there are multiple requirements, right? These are very common head and shoulders. This is the neckline, right? For example, is already making like this, and then you think, oh, it's making a head and shoulders, and then this neckline came all the way here, right? All the way to near your head, and you still think, oh, it's head and shoulders, it's head and shoulders. This is the neckline, this is the neckline, right? Then you are just in denial, because it is no longer a head and shoulders. It might be even a double top or even a triple top pattern, right? Just that you didn't realize, and because you are just married to your idea that it is a head and shoulders pattern, right? So never ever be too stuck on an idea, and always look for various clues, right? Actually, the market is actually uh playing playing a game with you, right? So all you have to do is figure out the clues. Oh, I get some clues from the Fibonacci's, I get some clues from the volumes, I get some clues from the chart patterns, and then with all these clues, I can enter the trade, right? So like I said, don't get too married by the trend. But before that, but let's just get back to our flag pattern, right? So in our flag pattern, once again, is characterized by this rectangular here, but with a flagpole. So it does look like a flag, right? So this is a flag. It looks exactly like this. Okay. So a flag pattern is also a bullish continuation pattern, right? So let's say before that, prices are increasing, right? There's increasing prices. However, when the flagpole forms, it is usually of increasing volume, right? Volume increases. You can see there's an increase in volume, right, in the flagpole. However, when it enters the flag, right, when it enters the rectangle, volume lowers down. So when it is oscillating, volume decreases, right? It becomes very light. And then when the breakout happens, once again, the volume is high. So what is happening is usually prices are moving up, right? Prices are moving up. Sorry, let me just draw this. So prices are moving up, and then you see this sudden spike up, straight line spike up, and it is driven by volume, right? Because higher volume means higher demand means higher prices, right? Because demand is more than supply, right? So this causes prices to increase, right? It makes perfect sense. So when volume is high, there will be this thing forming, right? And then when it's in oscillation, volume is low because people are in indecision, right? They do not know whether to sell or long, right? Which causes this flag, right? Which causes the flag. And when it breaks out, people want to get in because not only you, not only me, we are not experts, right? Everyone is the expert. Everyone knows about all these chart patterns. Everyone is looking out for them. And when everyone saw the breakout and saw the retest, everyone will get in at this breakout before it pushes higher, right? So it characterized by another higher volume. All right, so this is actually maybe how chart patterns are formed, right? Maybe you can tell me, oh, all these chart patterns are gimmicks, right? How can it possibly form, right? But it's because everyone is using this method. That's why it probably works, right? Because everyone are looking out for these patterns. How the patterns are formed, though, you can either say, it's the market makers. They are the people who are trying to form the patterns to let them get in early, right? So for example, even before the breakout, they get in early, right? And then in the breakout, they earn the money before getting out of the trade, right? You can either say it's because of them, or it's because market just reverses back to mean, right? There cannot be a straight increase all the way. There has to be some consolidation, right? And all these forms the patterns, right? And these are actually probably how the patterns are formed, right? So whether these things are myths and whether these things should be followed closely to your call, because all these are actually different trading strategies, right? And people can adopt different trading strategies. So whether it works and whether it is by nature or by human formed, right? We will never know, right? We will never know. So this is all I have for the flag, right? This is all I have for the flag. Now we have the pennants, right? So we look at pennants now. So just now, like I said, flag is literally looking like a flag. Okay. So now the pennants is very clear. It's actually also actually looking like a flag, with the flagpole, right? Both can be seen from the flagpole. That's why we classify it together. So once again, this flagpole, high volume, right? With higher volume, higher demand, higher prices, right? Demand versus supply, right? So at the top, the pennant, however, is downward sloping. So you can see a triangle, right? Almost like a converging triangle, right? It's a symmetrical triangle. And prices enter into oscillation phase. And in the oscillation phase, volumes lowers because it's indecision, right? People do not know whether to sell or buy until there's a breakout. And when there's a breakout, there is usually high volume. People are buying, drives the price out of the range. This is the range, right? It is converging within the range. It breaks out of the range, come back to retest trend line before pushing up higher to our profit target. So in the slides, right? In the slides, what they are saying is that prices will move exactly the amount that of the flagpole, right? So for example, the flagpole moved by $2, right? So they are saying after it breaks out, it will move also $2. For me, once again, I would like to say that it's not the most accurate, right? Because you can go and back test. Actually, you can go look at charts with flag patterns, and you can see how many times it actually either goes more than the flagpole or not yet, right? There are so many times where it did not reach the length of the flag, probably because of some news, right? So it probably did not reach the flag. So you cannot just base on this slide and then go trade based on the length of the flagpole, and that will be your profit target. Like I said, you have to make use of Fibonacci, right? You have to make use of graphical levels, right? If it's a strong support and resistance level, right? So for example, there's a strong resistance and support level here, right? And your target is here, right? it is more or less harder to break through this support and resistance zone, right? Because this zone here is probably very strong, and prices will probably come back and do oscillations, right? So there's there's a higher chance that it might do oscillations that it break out of this zone here. So once again, you must look at graphical levels, you must look at Fibonacci levels before you make a decision on where to put your profit target. But for a guide, like I said, this slide is just for guidance, right? So if for a guide, for starters, you look at these patterns, then these patterns, you can use this as a guidance to put your take profit and stop loss levels. Once again, I would not recommend doing what is said in the slides. Okay, so I'm pretty sure we don't need to say too much on bearish flags and pennants already, because I have already elaborated so much on bullish flags and pennants, right? So bearish flags and pennants is basically breaking it out from the other side, from the downside, right? So prices break out from below the trend line, come back to retest before pushing down, right? Pennants the same thing, just that you can see that the flagpole is reversed, right? Before that, you can see that the flag is this manner. However, in this case, you see the flag this manner, right? As for pennants, you see this manner. However, in bearish, you see pennants in this manner. So it's actually quite clear, right? Once again, do not mistake pennants with our triangles, right? So like I said, the one that characterizes the flags of pennants is the flagpole, right? There's a straight drop or a straight increase, right? And it's usually characterized by high volume, right? High volume. So all these are actually telltale signs of how to spot all these patterns, okay? Okay, if I'm not wrong, this is the last pattern that I want to cover with you all, which is rectangles, right? Rectangles. So for rectangles, it's actually the most easy to identify, right? Because all you have to do is to identify a rectangle, right? So a rectangle isn't hard to identify, and prices will be oscillating within the rectangle, right? Oscillating within the rectangle. So it is the most easily identified pattern, and it rallies on heavy volume and setbacks on lighter volume. And formation is probably a continuation in the uptrend. So if a heavier volume is on the downside, then it can be considered a warning of a possible trend reversal. Okay, so for rectangles, actually, it is very, it is more uh like versatile, right? It's more versatile, right? So if a breakout in the upside, it might mean a increase in prices. However, a breakout in the downside might cause a decrease in prices, right? So it is very versatile, right? So for rectangles, once again, like I said, back to the first slide, you have to make reference to the volume, right? Volume matters a lot about when talking about chart patterns, right? So if there's a breakout in the downside and with high volume, then yes, it will probably be a reversal in trend, right? It might not be a continuation chart pattern, right? However, more than likely, like I said, this is just a probability thing, right? So if you go inside a rectangle, more than likely, if it breaks out, it will break out to the upside with higher volume, and it will show the continuation of an uptrend. So later I will bring on a, trend continuation rectangle to show your example, right? Okay, so this is basically our rectangle pattern. Okay, so there's actually nothing much to learn once again, or much to understand. It's just looking at the pattern and knowing how to identify them. If not, if I'm not wrong, I have actually come to the end of the slides, right? Okay, so I'm not gonna cover on bearish rectangle because it's exactly the same thing, and I already said rectangles are very versatile, right? You can break out from either side. Okay, so I'm not gonna cover on rectangles now. Okay, so if I'm not wrong, this is the last slide, and I have come to the end of the slides, right? So let me just show you some of the diagrams. So you all know in real life what it looks like. Okay, what it looks like. So let me just pull out my charts. Okay, so since we were at rectangles, right? Let me just pull out the this graph on KiwiCat, right? KiwiCat. So this is the rectangle, right? You can see here clearly, right? It's oscillating within this rectangle. I have already boxed out this rectangle for you, and I drew a very nice rectangle for you, right? So once again, prerequisite of a trend, a prerequisite of a chart pattern, right? The first one, looking for a trend, right? So you can see KiwiCat downtrend, very clear, downtrend. Okay, so if you do not know how to draw a trend line, you can look at the lower highs, lower lows, right? Because just now the trend line only touched 2 points, right? So you think, oh, it's not a good trend line. Is it still a downtrend? Very easy. Look at the price action. Lower highs, lower lows is a downtrend, confirmed. Okay, next thing, is it oscillating? Yes, you can look. If I zoom in, and you look at the candles, right? It's all doji candles, right? What does doji candle means? If you came from my previous lecture, you will know, right? Doji candle, small body, long wicks, right? You can see many doji candles here, right? 1, 2, there's too many count, right? So it's all made out of doji candles, right? Which shows indecision in the market, and indecision shows oscillation as well, right? So you can see price is making up, down, up, down, up, down, right? It might not be touching the tip of my triangle because my rectangle is not the most accurate. Okay, let me just adjust maybe the rectangle a bit. Right, and you can see prices are actually touching the tips of the triangle, rectangle, right? Went up, touched the top, came down, went up, touched the top, and came down, went up, touched the top, came down. And then you see here, I want to bring your attention to this very huge and large red candle, right? This is probably the sign. This is probably the sign of a breakout, right? Because it is high in volume. It is high in volume. Why? Because it's so large, right? It's so huge, right? So it signals a break, right? And for in KiwiCat case, there's no retest, right? Because the downtrend, the push down is too strong, right? It's too strong. So this is actually the perfect example of a square pattern. Okay, square pattern. Sorry, rectangle. There's no square pattern. Okay. Okay, now we take a look at Euro franc, right? We look at the bullish symmetrical triangle now. Okay, so we look at a bullish symmetrical triangle. Okay, once again, how to look at triangles? Only 3 types of triangles, right? Symmetrical triangles, okay, ascending triangles, descending triangles. And in this case, you can see prices are making low highs, okay, lower highs, lower highs, lower highs. And as for this place, is making higher lows, right? So you know that it's converging, right? You know it's converging. So via converging, you know it's a converging bullish symmetrical triangle. So this is the apex, right? So this is the apex. So okay, like I said, based on what the slides is saying, prices will increase until here, right? They say that from the apex, you draw a line, it should be vertical to here, and this number of pips should be equivalent to this number of pips go up. But my take is that along the way there will probably be some spike down, right? So you want to take profit at a clean move up. So I would not put the take profit at the same number of pips as this, right? Because it's just not the most accurate. Okay. So before we look at how I'm going to put my take profit levels, I'm going to show you the pattern, right? So you can see here is oscillating, right? Within here is touching the tip, bounce down, touch the tip, bounce up, come down, come up, come down, right? You can see the clear V's and A's, right? You can see come up, come down, come up, come down, is oscillating, right? However, here, okay, once again, I wouldn't use the 2/3 or 3/4 method, right? Because look here. Here, when it came out, I'm pretty sure this is more than three quarters of the triangle already, right? So when it came out, like it came back to retest the trend line before it pushes up. So one trick I will do is I will put my entry here, right, at the crossing, at the cross. So I will enter at the cross, right, enter the cross. Okay, so I'll put entrance here, right, because it's a confluence zone between the upper trend line and the down trend line, right? So a breakout and a retest. So you are expecting for the retest, and I'll enter at the retest, right? Enter at the retest. So it's highly likely that prices will retest here. So this will be my entry, right? So I will set a buy entry. Okay. So next thing I'll do, set a stop loss, right? For stop loss, what I will do is set outside of this structure, right? Because a stop loss is basically an invalidation of your idea, right? If your idea is wrong, you want to quickly get out of the trade. You wouldn't want the trade to go wrong, right? So a trade, a stop loss I will take is probably here, right? Is outside of this triangle, right? Because you are entering the trade based on this bullish triangle, right? And you're expecting it to go up, and you have placed your entry here at the intersection. So any below, I'll just put it at this swing low right here, right? So it's a graphical level, so it looks nice. Okay, so I'll put it as this swing low. So when I have this thing tagged, I'm going to need to find fib levels, right? Fib levels to determine my entry. So what I can do is probably I can find a Fibonacci retracement first. So I can take a from low to high, right? And then if I open, that's hopefully 161.8, right? Is quite near to our stop loss level, right? I can even put it here, right? It's quite near to this swing low, okay? So I can put this as my stop loss. Right? So this will be my stop loss level, okay? And last thing I can do is to find my take profit. So my take profit, I can take a retracement, like I said earlier, from here to here, right? So what I can do is I can take from here to here. I'm just doing an aggregation, right? I'm just doing an aggregation, so it's not exactly accurate. So pardon for my Fibonacci drawings, but just take note, right? Just take note that when you are taking your Fibonacci, it has to be tagged to the wicks, right? But because I have drawings here, I'm just going to take an aggregation. Okay, so I will take the 127.2% level, and you can see that 127.2% level lines up very nicely with our swing high resistance, right? So maybe I can put it slightly below our 127.2, so that even in the case that it doesn't reach, we will have taken a profit, right? So in that case, I'll put our take profit here. So this is actually how I will put my key levels, and how I will use the diagram as well as volumes, maybe even indicator, right? If I were to look at the indicator, you can see that prices have broke through the Ichimoku cloud. I just use Ichimoku cloud because it's already here, right? Okay, so let's say prices has already broken through the Ichimoku cloud, and now Ichimoku cloud is below our prices, signaling a bullish pressure for prices, which is in line with our analysis, right? Because if the price, you can treat Ichimoku cloud like a EMA, right? Like a moving average, right? When EMA is below your prices is bullish, right? It means it acts as a support trend line as well, right? So as for Ichimoku cloud in this case, it acts as a support as well, right? So the break through the Ichimoku cloud also signals a breakout in prices, right? So this will be my setup for example, Euro franc. Okay. So I actually have come to the end of my webinar. Is there any questions that you all want to ask? Okay, if there's no more questions that you want to ask, I would like to thank all of you all for spending your time on this webinar. Once again, I apologize for the mess up on doing two same topics in a row, and I would like to thank all of you all for being very wonderful audiences and listen attentively. Right, no problem, William. Thank you, William. And with that, I'll just like to wish all of you happy Good Friday and good Easter Monday, right? With that, thank you for listening and tuning in with me on the last working week, and trade safe, stay safe. Okay, bye everyone.